The stock market is a device for transferring money from the impatient to the patient. Warren Buffett. Episode number 2, date June 21st, 2025. Assets now have grown to $2,467. Welcome back to episode number 2. So I mentioned that it's not going to be, every week that these episodes are going to be coming out. So what I'm going to do in this episode, my main goal actually is I kind of collected up. There were some questions that have been asked. It was nice to see. So I kind of cleaned up the questions and I will be able to answer those questions that people had. So here are the set of questions that we're going to go through. Now, before I jump into the questions, I just want to let you know where we stand, what has happened, okay, and what the process is. So in episode number 1, if you didn't watch it, I'll put up a link up above there. So if you're new to this particular 1 million journey in terms of investing and the discipline to be able to do it, this is what I wanted to be able to do. So the fund is $1,000 being invested, and it is invested and split into these 2 particular assets. I am also tracking this, and I'll talk about this soon enough. All right, and there's no selling. Okay, we're going to be rebalancing at the end of the year. I'll talk about rebalancing actually from one of the questions. We are purchasing all the dividends, okay, in terms of new purchases for XAW and VCN. So you can look there in that episode. So I'm not going to go through that, but I wanted to keep this in mind. The other component is the important thing to me is that if I was giving this advice to my kids or to myself, to my younger self, I wanted to be able to stress these checklist items. I've included these. They're also from our first episode. Where do we stand today? So here it is. That's our account. All right. So this is live and live. Markets are closed. It's a Saturday today, but this is basically the real account that I am going through. So we started with nothing, and this is where we are currently. So we have grown, about 3% or so overall. Now, the growth at the moment doesn't really matter. To be honest, I was kind of hoping at the time that markets would keep crashing, but they didn't. So notice in here, we have our XAW and VCN. So it is set up on recurring investments. Okay, so that's something that happens. I do have stock lending set up. I can talk about that in the future. You can let me know if this is something you want to learn about. Here are holdings. These are actual real holdings. So yes, so we're 0.3% up at the moment. And they're split between VCN and XAW. And I have basically done 2 purchases. One was in April and then one was in May. And I'm going to have one which is coming up for June. And you'll see that. You can see that in the date where the recurring investments are coming in. So everything is fully automated. Now, where is it automated? So I'm going to go in the top right-hand corner, okay, on the settings there. So that's our account. And notice, so within here, so these are where all the automations happen. So stock lending is on. Recurring investments are on. I am buying it from a different account, and then it just automatically purchases every single month towards the end of the month. I think like 28th, 29th, 30th, depending on, because if it falls on a weekend, it won't purchase. So it's somewhere around towards the end of the month. Dividend is fully reinvested, so that is on. So that means if I am paid out dividends, we'll see that eventually. It's probably going to happen within a month or so. It won't be a lot, it's going to be a few dollars because we're not holding a lot, but that automatically purchases back. So if I get dividends from XAW, let's say it's $3 or something, or $2 or $1, then that amount, will get chucked in, and then it will just buy partial shares of XAW. If the same thing happens for VCN, the same thing will occur there. All right. So that's what I have. Recurring deposits, I have that off, although I am purchasing, but I'm purchasing not from this account. I'm purchasing it from a different account. That's where we have it. Now, I also want to point out to you that I've set up the cash account, which is 20%. So I basically invest 1,000. 20% of 1,000 is $200. Okay, so that's something that I'm doing as well. So here is that one. So that's the account, and yes, I do have it with Wealthsimple, so there's interest on it. So it does accumulate a little bit, but not a lot. All right, and I'll talk about cash a little bit further. So we have these two, and we add them together, we get the full amount. Now I have started to track, and I will also show you, and hopefully you can learn to do that yourself. So I have actually just entered these in. Beforehand, I was contemplating, do I enter it and show you how this thing works? Then I ran it, I recorded, and it was just way too long. So here it is. So I've just kind of entered it all in. So I'll talk through it. So the one all the way at the bottom, now it's pretty easy to understand. You see there's XAW, VCN. So let's concentrate on those. And then it tells you which date they were purchased. So April 28th. And then May 28th. So those were the two purchases that you have. And then the top one all the way at the top. So that's this one. Okay, so this is that one right there that you see. That is just the full currently. So if I ever want, I can just go in on the day like I am doing right now. So June 21st. And then I can enter the full amounts from what each ETF is worth. And then it just calculates for me. So I have the total shares there, and then the total account in terms of costs, and then the current prices. So notice that it has gone up there ultimately. And then I have a line for my cash, because that also will be accumulating a little bit over time. Now, the one thing that I wanted to point out, because I said in episode 1 that I'm going to also track VT, which, to be honest with you, I mean, if you have US accounts, it's probably the best way. There's nothing to do with rebalancing or anything. It's just literally just one thing that you're buying, which is the entire world index. So notice that VT has done better than our account. So our account is 2,066, and then VT would have given you 2,078. So it's not a lot, at least for now. But imagine you had $1 million. Okay, then the spread starts to become rather large. Now, the only thing is VT is in US dollars. Now, the US dollars in comparison to Canadian dollars has fallen over the last few months, and that's why VT is actually a little bit higher. But if we would transfer that back to overall Canadian dollars, it would have probably balanced off. Not that we have to, don't stress over that. That's not last thing you want to do is try to cherry pick and then try to figure out, ultimately what you have is you have control over costs, right? So our costs in terms of managing these are basically practically almost zero. That's what we want to do. Okay, so enough of that. I hope that gives you a sense. You can let me know if you want me to, possibly share a spreadsheet like this, and then I can include it to future episodes. So I'll listen to that, okay, and then what the community wants overall. So now that we can see where we are, so there are a few questions that were asked. First question was, why are you doing this? Which is a great question, right? I mean, why in the world do people want to do this? Most of the time, there's some incentive. All of us as humans are incentivized. Now, many internet gurus, they're doing it because they want to try to make money, right? They'll sell you books, they'll sell you courses, they'll sell you all kinds. I am not selling anything here. In fact, I'm kind of giving it all away and then tracking it throughout. So the main reason why I'm doing it is because years ago, I have set up the 1Mjourney.com website. And if you go back to that original mission, so you can, click on that mission, okay, and I'll kind of display it here on the screen as well, you'll notice that this was my ultimate drive. Now, I don't know exactly why, but I get a lot of enormous positive energy through helping somebody else do well. And, if you've ever been a student of mine, okay, you've noticed, at least I hope, I'm not perfect, but that's what I try to drive at, and I love seeing other people do better. So because I've been fortunate enough to get myself from kind of the bottom and then, rise up along the investing side and seeing it work, through a lot of pains, of course, I wanted to be able to see, okay, can I share that so that maybe I can save somebody time, right? It took me longer. If I followed this strategy, I would have done a lot better today than I would have when I started back in the day. So my ultimate goal is to be able to share it. And yes, there is some sense of like, oh, if we can have this community grow, okay, with like-minded people, people who are going to be signing up, and if we start growing to, let's say, like 20 and 50 and maybe 100 people who are going to be starting to sign up for, the little newsletter summaries, which, by the way, you can email me at if you want to be added. I do a summary of the full episode and then send it to your email. Then in that case, it will be amazing because we're going to be building out a community. And, what better way than to have a community that you can, interact with, share with stuff, ask questions, etc. So that's really the main reason. Okay. The second one is, how do I know this process will work? I will be honest with you. I don't know if it will work, right? That's what any investments are all about. None of us know. I mean, we don't even know what's going to happen today or tomorrow to us in terms of our health, our loved ones, etc., friendships and things of that nature. So investing is the same. I don't know if this will work. Now, of course, you might say, well, then I don't know. I don't want to really do it. I put up a warning, right, in episode 1, and you're going to see it on all episodes. Ultimately, you have to decide. What I am trying to do is trying to think of how would I possibly share and start from the beginning if I knew what I know now. And because I have kids, I want to be able to share and try to ingrain in them the discipline of investments, because I do find that probabilistically, it is wiser and better for you to invest, for example, in the strategy that I'm presenting than it is for the alternatives. For example, like spending cash all the time, being in debt, sitting on just cash at all in a savings account. Okay, so those things in terms of probabilities do not compare, at least historically, to the process of investing. So although I don't know 100%, the probability is higher by doing this than the alternatives. Now, of course, there are some alternatives, except they're just really, really hard, where you can certainly make more money. But those are not the ones that I'm going to be sharing. One key thing is I want to be honest and transparent with you. So hence, you're seeing everything live as the account grows. The third question here is, what exactly does rebalancing mean? So it's a very good question. I will do rebalancing actually at the end of the year. And I will do an episode and, I'll kind of show you what it is. But here it is in short. So in short, we're holding XAW and VCN. We said that we're going to be buying. This one is going to be 90%, and then this one is 10%. Now, if you keep doing this month by month, of course, XAW and VCN are going to grow or drop, okay? But you will have your overall account. So at the end of the year, you'll have your full account, whatever it might be, okay? Now, what you will notice is that these two, they're going to possibly maybe be close, but they may not be close. So what might happen at the end of the year, you maybe started to buy things at 90% and 10% of your total account, but you might notice that this one is, let's say, 85% at the end of the year of your total account, and this one is 15% of your total. Okay. Now you might say, how did that happen? Because I was buying at 90 and 10. Well, the reason is because of growth, right? Or drops. Okay. So you don't know what will happen. So that's now a problem, because it's not a problem, but we would want to try to keep it at this particular proportion, 90 to 10. So at the end of the year, we will rebalance. We will buy so that this is 90%, okay, of my total account, and this will drop to 10%. So maybe we won't buy this one at all right? And I'll talk about that in the future. So that's what really rebalancing means, okay, with regards to accounts. And you can let me know in the comments if you found that helpful, or if you need, more of a discussion. You can poke at me, and I can certainly point you in the right direction without necessarily waiting for the next episode. All right, so another question is, what are dividends and how do they benefit long-term investors? So another great, question in here. Now, dividends in general, okay, so if you have a company, I'm going to let's say we pick Apple, All right, so Apple, and the ticker is, I believe, AAPL. Okay, so Apple, has a certain amount of revenue, so it has money coming in, okay, and then it has all kinds of costs, okay, so revenue minus cost. Typically, I'm not going to break this down into a business class, but then this would give you your total profit. And then, within the costs, you maybe have taxes and all kinds of other things. So you have a certain amount of profit as a company. Now, what do you do with that profit? Right? So the question is, do you want to still continue to grow? Maybe you want to put it into research, like Apple, into developing new products, new technologies, completely, new, maybe something in terms of services, etc., as they're doing more and more. Okay, so you can try to invest in that and then see if that would generate you more revenues. So ultimately, this is what you want to drive. Cost is something that you want to try to bring down. Okay, so revenues you want to try to bring up. And then, of course, profits you want to try to bring up. But, you might allocate a certain amount of money, but out of that allocation, maybe you'll still have some money left. Now, you might have your margin of safety for the company, which is very reasonable. So you might hold a certain amount of cash, okay, just in case. But then if you're already comfortable, right, how much cash you're holding, you might say, okay, I don't really know what to do with it, so I'm going to give it back to the people who own it. And you're the owner, you're a shareholder. So a company will give you a dividend, all right? So they'll pay you back. So that's called a dividend, okay? So it's kind of the shorter explanation. Now, with that dividend, you can do whatever you like with it. Now, most of the time, you get taxed on it as well. So, be careful of that, okay? So just a reminder, because at the end of the year, or at least next year, we're going to have to claim our dividends, okay, for tax purposes, especially if it's in a non-registered account. So, does it help? Yes, of course, it can help because now you have extra money, you can now reinvest it. I said that we are reinvesting it back. So XAW and VCN, actually probably very soon, within a month or so, they're going to be paying out dividends. Now, these dividends are a collection from all the companies that we own. And if you haven't looked up which companies you own, I do encourage you to do that. Look up for XAW and VCN and then just check out all the different companies. Now, they typically don't list all of them unless you go in the full documents, but you can see very quickly, your top holdings, and Apple's going to be one of them. So when we do get that dividends, I basically say, if this pays me out the dividends, I'm going to repurchase this back just so that I own more of it. All right, and of course, and then I'm going to get paid more dividends down the line, but I'll just keep repurchasing. So, long term, it does obviously try to help us. Now, it doesn't matter if we get that money back or not. If Apple or any other company just didn't want to pay out the dividends, because some companies do that, but they want to reinvest it into themselves, meaning into that company, so that they can keep generating more revenue. If they can generate more than you can by your investments, then great if they hold it. Berkshire Hathaway, for example, is a company Warren Buffett owns. They do that. They don't really pay out any dividends. They'll just hold the cash so that they can keep buying and reinvesting. But not all companies want to do that. All right? Okay, so ultimately, it's nice if we get it, but it doesn't really matter if we do or not because we're looking for growth. And ideally, actually, growth in the company is a little better for tax purposes. So that's called capital gains, if the company keeps growing, because we're taxed less, okay, than dividends. But if a company doesn't know what to do with their profits and cash left over, then, most of the time, eventually they'll start giving it back to the shareholders. All right. So that's a little bit about dividends. Should I reinvest, okay, the dividends, okay, that we have? So let me highlight this one. So yes, I've already, I guess, answered that with the other one. What's better for long-term growth? To us, it doesn't matter. I mean, I'm assuming that if you're asking what's better for long-term growth is, if you keep reinvesting, unless you find something, okay, to do with that dividends so that it gives you a little bit more back, okay, overall. Okay, so I think I've answered both of those already. How much cash should I keep as ammunition during low markets, and when should I use it? Okay, so this is a great question. I think it goes back maybe to episode 1 because, I said we're keeping this cash as a margin of safety. Now, to be honest with you, for the moment, keep in mind, we're just starting this process. So it's not like we've accumulated a lot of cash. The cash for the moment, if it was my thinking, is more so that, I can sleep at night and I'm trying to accumulate cash in case there are unforeseen circumstances like loss of job or something, that happens beyond something, okay, that it's kind of out of my control, but I need the money for. Because what I don't want to do is I don't want to invest everything. And then when, let's say I lose my job, I might have to pay my bills. And then if I have to pay my bills and I don't have any cash or savings left over, then I'm going to be forced to sell my investments, right? And that's not something that I want to do. Let's imagine, like over time, we don't want to touch the investments. So we want to keep investing, and then we want to have enough cash. Ideally, my idea is always about 6 months, actually to a year of cash to pay just in case, okay, things happen in terms of all the bills and all the expenses. Now, I have a family, I have kids, so that might be bigger than what you have if you're maybe single, but it's, everyone should have some cash just in case. That's kind of my philosophy. So my philosophy is I don't want to have nothing and just rely on paychecks, because what if that paycheck doesn't come, and you lose your job or something, and then what? Well, now I want to have enough cash so that I have enough time to look for another job, etc. And then hopefully the ultimate goal is obviously we want to be financially independent so that these investments keep now, let's say through dividends and through growth, they basically, pay our bills for us. All right. So that's the key. Now, if we build enough cash and all your bills and stuff are covered, then eventually, yes, you're going to be waiting for kind of ammunition when the markets drop. And then we just buy more. All right. So that's what I love to do. Okay. And every single time it happens, I always kick myself because I always say I should have bought even more. I was too conservative. Here's another question. How can I prepare for market dips? Okay, will you guide us? Honestly, I wish I would have started this, maybe even in the beginning of the year, because we would have had, it's not really huge, it's 10-15% market drop, but for some people that's a lot. So I wish we would have maybe started a little bit earlier, because you would have seen me doing exactly the same thing. So, will I guide you? I will do exactly what I've been saying. I'm not going to really deviate from that. And if it keeps dropping, which I was hoping it would drop, so that I can just keep buying lower. So, will I guide you? I don't know if that's called guidance, but I think I will try to stay, the temperament will be the same, right? Up or down, we kind of want to be neutral, okay, throughout. Now, panicking. This is, unfortunately, you kind of have to live through some of these. When it happened to me originally, believe it or not, I did start to sell. Because I didn't really have anyone as a mentor, aside from starting to read books a little bit, to tell me like, hey, hold on, we kind of want to be disciplined, and these are not the moments that we want to be able to sell. And most of the time we want to be able to buy when people are panicking. So when it does come to that point, I will in fact indeed try to do episodes and then kind of show you what I'm doing, okay, as well. You have to live through them. So again, invest money that you don't need. Follow exactly what I outlined in episode 1. Don't invest more just because you're seeing it go up, because there's going to be time where you're going to be really in pain where things might be dropping. Here's another one. Is it smarter to keep money in a checking savings account like Wealthsimple, for instance, like I'm doing, okay, or TFSA or FHSA? Well, first off, TFSA and FHSA, these are registered accounts. So you can hold investments there. And TF, which means tax-free, it's just a simple account, just like any other. It could be an investment account. You can hold there whatever you like. You can hold there a savings account, a GIC, which is guaranteed investment certificates. You can hold their investments like we're doing, XAW and so on. And with Wealthsimple, you can do all of that, which is amazing. And indeed, I typically would encourage people to maximize that first. So as you're going along before you start opening non-registered accounts because they're taxed. Now, FHSA, which is a first home, okay, savings account, that one is obviously different. I do own a home, so this won't apply to me anymore. But if someone is younger, wants to stay in Canada, and definitely is going to be buying a house, then yes, do utilize it. Maybe you're teaming up with somebody else, okay, so that you can have these because they're tax free, and then when you buy your home, you can then withdraw the funds. Now, that is a little bit different, and that's not something that I want to advise you on because it will depend on when you're buying your home, etc. Right? Okay, we are investing in something which is long-term forever. So, I wouldn't really hold that for FHSA. The TFSA, it can be, forever, and definitely it's tax-free, so it's amazing. Now, regular savings and checking accounts, like the one that I have for cash, okay, so those are just non-registered, so I have to pay taxes on all the interest that accumulates there, etc. So number one, maximize your TFSA, and then you can flip over to the checking and savings. The FHSA, that has to do with homes, and that's a little bit out of the scope, okay, from what I want to be able to discuss here. Although you can certainly put comments, etc. If you like to, and I will try to do my best, okay, to follow up. Should I use one stock app, okay, like Wealthsimple, or spread it across? When you're just starting, unless you start building out a lot of wealth, you just keep it simple. Wealthsimple is great. I'm not affiliated with Wealthsimple at all. I just really love their application. I love where they're going. I'm following exactly what they're trying to do, trying to build. I like the CEO's message, kind of where they're trying to head the company. So, it's fine if you hold it there. They have, really good insurance on, all of your accounts, which is great. Keep things simple. Keep it in one for yourself if you can. All right, so that's pretty much it. Lengthy episode, but I hope that you found the answers useful. And let me know if you're still on us on this particular quest and journey. I'm curious if anybody has signed up, okay? I did get a notice that somebody did in terms of Wealthsimple. You can use my code, okay? I'll put that up in the description, okay, so that you can get some money back if you are signing up with Wealthsimple. All right, we'll see you in episode 3 in the future, okay? Until then, just stay disciplined, enjoy your hobbies, try to keep smiling as much as you possibly can. Bye, everybody.